Preparing for a financial analyst at Endesa interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you analyze Endesa's financial performance? I would start by understanding how Endesa earns money across generation, distribution, and retail. Then I would analyze revenue drivers, fuel and power price exposure, regulated returns, operating costs, capital expenditure, working capital, and cash conversion. I would compare actuals with budget and prior periods, investigate variances, and assess whether reported EBITDA translates into sustainable free cash flow. Finally, I would present risks and actions clearly, rather than simply reporting numbers. While answering, focus on Endesa's generation, distribution, and retail activities, revenue drivers, power price exposure, regulated returns, operating costs, capital expenditure, working capital, cash conversion, and meaningful variance analysis. Question 2. Walk me through an EBITDA bridge for Endesa. I would begin with prior period EBITDA and separate the movement into operational and non-operational items. For Endesa, I would isolate electricity volumes, realized prices, generation mix, fuel and carbon costs, regulated network revenue, retail margins, operating expenses, and one-off effects. I would reconcile each bridge item to the general ledger and management reporting, then explain whether the change is recurring. That distinction helps management forecast earnings and evaluate performance accurately. Make sure to cover the starting period, volume and price effects, generation mix, fuel costs, regulated income, retail margins, operating expenses, one-offs, foreign exchange, and reconciliation to reported EBITDA. Question 3. How do power prices affect Endesa's income statement and cash flow? Higher power prices can increase generation revenue, but the net effect depends on Endesa's hedges, contracted sales, fuel costs, carbon costs, and retail pass-through mechanisms. Unhedged generation may benefit, while retail margins can be compressed if customer prices adjust slowly. I would model price, volume, and cost sensitivities separately, then examine collateral, working capital, and cash flow effects. Accounting earnings may move before cash because settlement and billing timing differ. In your answer, discuss generation and retail exposures, hedging, contract structures, fuel and carbon offsets, timing differences, pass-through mechanisms, margin sensitivity, and why earnings and cash effects may diverge. Question 4. What is the difference between regulated and merchant utility earnings? Regulated earnings arise from assets or services where authorities set tariffs or permitted returns, usually providing greater visibility but depending on regulatory decisions. Merchant earnings depend more directly on market prices, dispatch, demand, and operating costs, so they carry greater volatility. At Endesa, I would analyze the two businesses separately before consolidating results. The mix matters because regulated cash flows can support stability, while merchant exposure can create upside and downside. Be sure to mention regulated asset bases, approved returns, tariff frameworks, volume risk, merchant price exposure, predictability, capital intensity, and how the mix affects Endesa's valuation and risk profile. Question 5. How would you forecast Endesa's revenue? I would forecast revenue by segment rather than applying a single growth rate. Generation revenue would combine expected output with realized prices and hedging assumptions. Retail revenue would reflect customer numbers, consumption, tariffs, and contract repricing. Regulated activities would use approved frameworks and asset base assumptions. I would add scenarios for weather, demand, commodity prices, and renewable availability, then reconcile the forecast to historical seasonality and management guidance. Focus on segment-level drivers, generation volumes, realized prices, customer demand, tariffs, customer numbers, regulated revenues, contract renewals, weather, market assumptions, and reconciliation against historical trends. Question 6. Which financial ratios would you monitor for Endesa? I would monitor EBITDA margin, EBIT margin, return on invested capital, net debt to EBITDA, interest coverage, operating cash flow, free cash flow, and dividend coverage. For a utility, I would also track capital expenditure relative to depreciation, working capital movements, and regulated asset base growth. Ratios should be compared with peers, historical levels, and guidance. A strong EBITDA margin is less meaningful if leverage rises or cash conversion deteriorates. In your answer, cover profitability, leverage, liquidity, capital efficiency, cash conversion, dividend coverage, interest coverage, and operational metrics, explaining what each reveals about a capital-intensive utility. Question 7. How would you build a financial model for Endesa? I would structure the model into historical results, operating assumptions, segment schedules, financial statements, debt, valuation, and sensitivities. Generation would link volume, price, fuel, and carbon assumptions. Networks would link assets, tariffs, and regulated returns. Retail would link customers, demand, and margins. I would integrate the income statement, balance sheet, and cash flow, include scenario switches, and build checks for balance, cash, debt, and circularity. Mention historical financials, operating drivers, segment schedules, assumptions, integrated income statement, balance sheet, cash flow, debt, CapEx, scenarios, checks, and transparent documentation of sources. Question 8. How would you evaluate a renewable energy investment for Endesa? I would begin with expected capacity, construction timing, resource quality, capacity factor, and grid access. The model would forecast generation, contracted and merchant prices, operating costs, development spending, taxes, financing, and decommissioning. I would calculate project NPV, IRR, payback, and cash-on-cash returns, then stress power prices, CapEx, delays, availability, and interest rates. A project is attractive only if returns remain acceptable after realistic downside assumptions. Make sure to cover resource assessment, capacity factor, construction cost, operating costs, power price assumptions, contracted versus merchant revenue, permitting, grid connection, tax, financing, NPV, IRR, and sensitivities. Question 9. What is the difference between EBITDA, EBIT, and free cash flow? EBITDA measures operating profit before depreciation and amortization, so it highlights operating performance before non-cash asset charges. EBIT deducts depreciation and amortization, reflecting the cost of using the asset base. Free cash flow goes further by incorporating taxes, interest where relevant, working capital, and capital expenditure. For Endesa, free cash flow is critical because generation and network assets require substantial ongoing investment and determine debt capacity and distributions. Be sure to define each measure, explain depreciation, amortization, taxes, interest, capital expenditure, working capital, and why free cash flow is especially important for utilities. Question 10. How would you analyze Endesa's capital expenditure? I would split CapEx into maintenance, regulatory, growth, and strategic investment. Then I would compare actual spending with budget, assess project milestones, and determine whether timing changes affect commissioning and depreciation. For renewable projects, I would test expected returns against power prices, construction costs, and delays. I would also evaluate funding sources and free cash flow impact. The key question is whether investment expands earnings and regulated returns sufficiently to justify the capital consumed. Discuss maintenance versus growth CapEx, renewable and network investment, project timing, committed versus discretionary spending, depreciation, return thresholds, financing, execution risk, and cash flow impact. Question 11. How do interest rates affect Endesa's valuation and financial performance? Higher interest rates affect Endesa through debt service costs, refinancing expense, project financing, and valuation discount rates. They can also influence regulated returns and customer affordability. In a DCF, I would update the risk-free rate, credit spread, WACC, and terminal value, then test the impact on equity value. I would separately review debt maturities, fixed versus floating exposure, hedges, and covenant headroom, because valuation and liquidity risks are related. Focus on discount rates, debt expense, refinancing, duration, regulated returns, project economics, terminal value, leverage, hedging, and sensitivity analysis across rates and credit spreads. Question 12. How would you value Endesa using a DCF? I would forecast segment operating performance, taxes, capital expenditure, working capital, and unlevered free cash flow over an explicit period. I would discount those cash flows using a WACC reflecting Endesa's business and financing risk, calculate terminal value with a perpetuity growth or exit multiple method, and subtract net debt and other claims. I would stress WACC, terminal growth, power prices, capex, and margins, then cross-check against trading multiples. In your answer, cover operating forecasts, unlevered free cash flow, WACC, terminal value, net debt, minority interests, scenario analysis, cross-checks, and the importance of regulatory and commodity assumptions. Question 13. What makes net debt analysis challenging for a utility? Net debt is more than bonds less cash. I would review lease liabilities, pension obligations, provisions, hybrid instruments, project-level debt, restricted cash, and other financing-like commitments. I would also ensure EBITDA uses a consistent scope, especially when comparing peers. For Endesa, the analysis should distinguish corporate liquidity from restricted or ring-fenced funds. This produces a more realistic view of leverage, refinancing risk, credit capacity, and equity value. Mention gross debt, cash, leases, pensions, provisions, hybrid instruments, project debt, restricted cash, regulatory balances, off-balance sheet commitments, and consistency between debt and EBITDA definitions. Question 14. How would you investigate a material budget variance at Endesa? I would first validate the data and confirm the variance is material rather than a classification or timing issue. Then I would decompose it into price, volume, mix, cost, foreign exchange, timing, and one-off effects. I would speak with the responsible business owner, trace the result to supporting transactions, and assess whether the issue affects the full-year forecast. I would communicate the root cause, quantified impact, corrective action, and remaining uncertainty. Be sure to explain materiality, data validation, price-volume mix decomposition, timing, one-offs, ownership, root cause analysis, forecast implications, and concise communication to management. Question 15. Which international financial reporting standards areas are particularly relevant to Endesa? I would pay particular attention to IAS 16 for generation and network assets, IAS 36 impairment, International Financial Reporting Standards 16 leases, International Financial Reporting Standards 9 financial instruments and hedging, International Financial Reporting Standards 15 revenue, and IAS 37 provisions. Decommissioning obligations and environmental liabilities can require significant estimates. I would assess assumptions, disclosures, and consistency between accounting and operational forecasts. For an energy company, impairment testing and hedge accounting can materially affect reported earnings and equity. Discuss property, plant and equipment, impairment, leases, provisions, revenue recognition, financial instruments, hedge accounting, decommissioning obligations, and judgment in estimating recoverable amounts. Question 16. How would you assess impairment risk for a power plant? I would identify the relevant cash-generating unit and compare its carrying value with recoverable amount. The forecast would reflect expected dispatch, power prices, fuel and carbon costs, operating expenses, remaining useful life, capex, and decommissioning costs. I would test both value in use and market-based evidence where relevant. Sensitivities around commodity prices, discount rates, utilization, and plant closure dates would show whether headroom is robust. Focus on cash-generating units, recoverable amount, value in use, fair value less costs, dispatch, power prices, fuel and carbon costs, useful life, discount rates, and downside scenarios. Question 17. How would you analyze working capital in Endesa's business? I would analyze receivables, payables, inventories, customer balances, collateral, and settlement timing separately by business. Electricity prices can inflate working capital needs even when margins are unchanged, while seasonal demand and billing cycles create timing effects. I would calculate days metrics, compare them with history, and identify overdue receivables or unusual supplier balances. The objective is to distinguish structural cash consumption from temporary movements and improve forecast accuracy. Mention receivables, payables, inventories, customer deposits, collateral, billing cycles, commodity settlements, seasonality, regulated balances, cash conversion, and operational versus temporary movements. Question 18. How would you compare Endesa with other European utilities? I would normalize peer data for business mix, geography, accounting, exceptional items, and net debt definitions. Then I would compare EV to EBITDA, price to earnings, free cash flow yield, leverage, dividend yield, margins, return on capital, and expected growth. Operational context matters. Regulated networks deserve different treatment from merchant generation, and renewable pipelines may justify investment. I would explain whether a valuation gap reflects fundamentals, execution risk, or market sentiment. In your answer, compare generation mix, regulated exposure, geography, customer base, leverage, growth pipeline, carbon intensity, valuation multiples, profitability, and accounting differences before drawing conclusions. Question 19. Tell me about a time you used Excel or data analysis to improve reporting. In one project, I replaced a manual monthly variance file with an Excel model using standardized imports, lookup tables, pivot summaries, and validation checks. I reconciled totals to the general ledger, documented assumptions, and tested unusual movements with business owners. The process reduced preparation time from several hours to under 1 hour and made explanations more consistent. I would bring the same discipline to Endesa while preserving review controls and clear audit trails. Be sure to use a specific example with the original problem, data sources, analytical method, controls, measurable improvement, stakeholder communication, and a lesson applicable to Endesa's reporting environment. Question 20. Why do you want to work as a financial analyst at Endesa? Endesa interests me because it combines complex financial analysis with an essential and rapidly changing industry. Its generation, retail, and network activities create different drivers, while decarbonization and renewable investment require disciplined capital allocation. I would enjoy turning operational data into clear forecasts, performance insights, and investment decisions. The role also offers exposure to regulation, commodities, infrastructure, and sustainability, allowing me to develop as an analyst while contributing to a business with visible economic impact. Talk about Endesa's strategic role in Iberian energy, decarbonization, renewables, regulated infrastructure, analytical complexity, learning goals, and how your skills would support disciplined decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.